All right, welcome back. Just while we're getting ready, it is interesting what you do read in some of these financial statements, and as I'll show you later, one of the frustrations that I've had as an investor and an advisor is trying to find suitable investments in New Zealand is very difficult. There's not that many that really fit the criteria for us as value investors. And I realise that you can go to any share broker or a newsletter or whatever, and they've got heaps of investments all the time, whereas I hardly have any, ever. And some of my clients wish I had more often. And I've seen a few comments where people are saying, oh, Flannery just holds them back, you know. I'm not holding them back, trust me, I'm trying to find them. And I look long and hard. So this afternoon, I've got a couple lined up, which I'll be able to talk about. In the meantime, I'd like to introduce you to Brent. Brent and I are kind of neighbours. I think we're misbehaving for a while with the earthquakes were on, so he's kicked us out of the lane. And we're allowed back at some point, I think.
Definitely.
But Brent and I have had the odd conversation in the lane, and yeah, it's really funny what accountants have to say about share brokers and financial advisors and the whole lot. But anyway,
Absolutely.
Today, Brent, I think, could talk for a lot longer, and we may get him back again to do a more in-depth chat, because I think he's got a lot to say. So I'll pass you over to Brent, and once Brent is finished, we're then going to have some lunch. So thanks, Brent.
Good stuff. Thank you, Peter. For those, my name's Brent Bartram. I've been a chartered accountant since about 1993. I started my working career in 1986, working out of a accounting practice that also had a share broking practice attached to it, which was relatively unique in those days, and I wanted to actually be a share broker when I finished up at Varsity, but I went to the accounting because it was a wee bit more, well, we thought a wee bit more secure. So value investing, what I'm going to talk about today is, Peter asked me to talk about taxes, and I thought, oh yeah, okay, we've got the pre-lunchtime session. It's going to be a wee bit dry and boring. You guys are going to be keen for some lunch. And I've only got about half an hour, so I'm going to have to steal 10 or 15 minutes of your lunch break because we've gone a wee bit over. But I'm not going to talk a lot about tax because we really don't have a lot of time to go into things in a great deal of depth. So I've put a wee bit of a seminar together here to talk about just a few things what's new in tax, a few things about did you know, and 10 things you don't get told or don't want to listen to, okay? So I'm just going to try and keep it a wee bit light-hearted and interesting for you. Like I said, I've been a chartered accountant since 1993. I was a partner in a large national firm of 70 partners, which I retired from just after the earthquake, took my clients and set up my own practice here in Christchurch. So I've sort of been through the ropes of coming through these big firms, seen the investing model. And also, when I was a partner in my previous firm, that firm took the initiative after the '87 share market crash to set up a financial planning side of the practice. And they developed that into the largest financial planning business in New Zealand and sold it out to one of the large insurance companies when we realised that this is going to hurt us if we stay in this industry, to be quite honest, because you always get blamed when things go backwards. So I've sort of had the unique opportunity to see it all. Now, value investing that Peter talks about, my first introduction to value investing was in 1986 when I was a young lad starting out in this accounting practice, and we had the share broking practice there. And our idea of value investing was we set up a whole business around drawing down on clients' overdraft and putting it on call deposits. So we would frantically get clients to write out a few $100,000 each day on their overdraft at 15% they were paying the bank, and we invested it overnight for 32 and 33% for them, and they made a lot of money from value investing, as we thought it was back in the pre-'87 share market crash. So there's a whole lot of crazy things that go on out there, and that was my first introduction to it, and I thought, yes, this doesn't look like it's very sustainable, but we'll make a bit of money in the meantime, and that's what we did. Okay, so what are we going to do today? We're just going to do some speed dating through these three areas that I mentioned. We'll spend about 10 minutes just having a wee scoot around. I'll bore you with a few little tidbits on tax. and then we'll just keep on running through. So first up, we'll get the tax done first. I know you had a session this morning on family trusts and that type of thing, so I'm not going to talk about those. I could talk about those all day, but we'll just... the gift, you probably got mentioned this morning that gifting is gone. Well, it hasn't really gone. The legislation is still in place. They've just changed the definition of what means a dutiable, what constitutes a dutiable gift. So I wouldn't necessarily say that gifting for your family trust or gifting those debts away is totally gone. I think there's probably quite a good chance that maybe successive governments might bring it back in. All they have to do is change one piece of definition in the legislation, and it's back in overnight and doesn't require a legislation change. So, but as far as it's concerned for you guys, it is an opportunity to gift those balances of those debts that your family trusts owe back to you. Okay, so it is an opportunity now to clean those up with a gift overnight. But personally, for a lot of our clients, what we're saying is don't be in such a hurry to get rid of the whole lot. There's a lot of good reasons why you might want to just leave an ungifted balance. You know, it might be 100,000 or something relatively modest, because it does give you the opportunity to keep drawing upon the trust and allow the trust to repay those funds back to you without having to make, you know, capital distributions and that sort of thing from your trust. Who's in business here? Who's got a business and who's retired? So we've got a few people in business. Yep. And we've got a few retired folk, I guess, and a few wage and salary earners. Okay, for you guys that are in business, no doubt your accountant's got you into all sorts of elaborate schemes with trusts and companies, etc., and elaborate sort of arrangements to filter income out to you, your wives, your partners, your children, your trust, and trying to get a tax advantage by getting that income out to some tax-paying entity to pay the least amount of tax. That was great. We had a great time doing that up until about 2 years ago when the tax rates with National were streamlined, and we brought that 39% top tax rate that we all hated paying and brought it all back down to a top rate of 33, brought the trusts, well, the trust stayed at 33 and the company went to 28. What we have to be careful of moving forward is the result of this Penny and Hooper case, which I'm not going to go into the detail of the case, but this is rather convoluted. But what the IRD have always said to us, for you guys that are in business, is that there's, you know, you ought to pay a market-related salary to yourselves. Okay, if you're working full-time in your business and you are worth $100,000 a year, hey, we don't think you should be paying yourself $50,000 a year and allowing the rest of the income to stay in the company or whatever, and then get filtered through to your trust and maybe distributed out to your children or other relatives, other family members, to get these tax advantages. The Penny and Hooper case was a couple of surgeons here in Christchurch that set up a rather elaborate tax structure to essentially pay themselves very low salaries and filter out their incomes to their family trust. Now, it was a very big case that went right through to the Supreme Court, and the IRD essentially won the case on appeal. And it's sort of paved the way for the IRD to have some teeth now about paying yourselves a realistic salary, because it's not written into the Income Tax Act that you have to do anything like that. It's just sort of policy, and the IRD love to have policy, but not often a lot of teeth around it to back it up. So what I'm just saying here quickly, for you guys that are in business, be aware that the IRD have now issued policy statements to say that if you are in business and you are a plumber, for example, where quite clearly you're earning the income, okay, and maybe your partner is doing the bookwork at home, typical scenario. The IRD's policy statement moving forward for that type of thing is they're saying you must now, we believe, distribute 80% of your profit to you as a salary, whether you like it or not, for tax purposes. That's what they're saying. They're going to head down that track, okay? So that you can't divert large salaries to your partner, who works 10 hours a week and gets paid $50,000 a year for it, or large amounts of your profit into your family trust. So we've got the policy statements now through from the IRD on this, so they're going to go through and they're looking quite hard at it. First up, they're looking at the various accounting practices throughout the country to see what schemes that we've dreamed up and are using ourselves, and then it's going to go through the high risk industries, and it'll become a much more prevalent attack from the IRD. So just be really careful on that. Loss attributing qualifying companies, who had one? Oh, goody, bank probably told you had to have one when you bought your rental property. Is that right? Yeah, I did that. They didn't understand how they worked though. Most of you will know for LAQCs, they have been replaced by a look-through company regime, relatively new regime. It's going to be very unpopular moving forward. I think the reality is, for most people, the LAQC company scenario with your rental property was a waste of time. It didn't really achieve anything. It was great for us because we got extra fees out of grinding out another set of accounts each year. The reality was it didn't actually achieve anything. So for those of you who have an LAQC, what I suggest you probably might like to do is just not register it as an LTC, a look-through company, unless there's some really good reasons. So make sure you've spoken to your accountant about whether we should move to an LTC regime. Undoubtedly, 98% of LAQC companies have chosen not to go into the new regime because it's got a significant number of fish hooks. And for most people who are not generating losses or own rental properties, you're probably advised to stay well away from it. So if you do have one, make sure you get some pretty good advice. There's a number of significant pitfalls with it that are going to catch people out. And logically, why not have your family trust own the rental property or just hold it in your own names? To me, that's a lot more simpler and gives you the same advantages. GST apportionment rules, for any people out there in business who have an asset that you use for both business and private use, okay, so it might be a car. Cars are very common, or a property, are very common. The rules around GST apportionment on what you can claim for GST on those running costs are now being significantly revamped. Hasn't got much publicity at all, unfortunately, but if you're in that situation where you've got private use or business use of a private asset or vice versa, talk to your accountant about what the new GST apportionment rules mean, because you're going to have to adjust what GST you can claim on those running costs or those assets, basically on a return by return basis now. We can't just dream up a private business percentage and she'll be right for another few years. It's significantly revamped. It's a total pain, the new rules, but just be aware there's some big changes gone there. The last little wee tidbit on tax, fringe benefit on motor vehicles. Does anyone pay it? No one pays it? Anyone got their car in their books? Okay, what do you got in your books? Car?
Just one truck.
One truck. Anyone got a car in their books? Oh, you haven't? One car in your books, you're paying FBT? No. You should be. Okay, talk to your accountant about that, FBT on vehicles. If you're a director of your company and your company owns a vehicle that is not a work-related vehicle, i.e. it's not a truck or a van or a bus or something like that, you will be subject to FBT on that vehicle whether you like it or not, and you should be paying it. The idea of having a bit of a crack on FBT. But it does have some advantages, because if you are a person that owns your vehicle for more than 5 years, and a lot of people do keep their vehicles, it's a great mechanism to throw that vehicle in the books, and after 5 years the fringe benefit tax is paid on a value of $8,300 odd, which is great. It means that the company can pay all the running costs, pay for towing the boat, pay for you going on holiday, pay for everyone under the sun who uses the vehicle, and get a full tax deduction for it for a really cheap FBT cost. So if you have got a vehicle in your books, talk to your accountant about how you can get that FBT cost right down. Did you know? Okay. There's a lot of people come to me and try to tell me what the rules are on a lot of things, and I was thinking, well, how do you actually get this stuff, you know? So what I've done here is I've just put down about 10 did you knows. LAQC, so for all you people out there who had an LAQC, you probably didn't know that the tax deduction rules are the same for every entity, okay? So the rules of what I'm allowed to claim for tax purposes, the mechanisms of how we go about it are the same for a sole trader, a company, a trust, a partnership, an LAQC. There's virtually no difference, okay? FBT applies to a company, that's a different, but you know, they're virtually all the same. So I'm sort of saying, well, when you go and select what entity you're going to trade your business through, don't make it more complicated than it needs to be really honest, because the tax deductions that you're going to get are going to be identical, whatever your structure is. Okay, there's very, very few exceptions to that and very little change. So don't come into to your accountant's office and say you want a really complicated structure. They'll love to put it in place because it will cost you plenty of fees. Okay, but you'll get no benefit. And with a streamlined tax rate now, where 33% is pretty much the top rate across the board for everybody, there really is no advantage. You're going to be paying the same amount, which will be the way you go. Don't come into your accountant and say, I don't want to pay tax, because you come in and you say, I want to pay as much tax as possible, because that's what you're there for, okay? If you're in business and you're not punting on capital gains, you're there to earn a profit, you're there to pay as much tax as possible. So it's our job to get your profits up and get you paying as much tax as possible, because the tax man only takes 20%, 30%, and the rest is for you. So the name of the game is to ring your accountant up and say, why am I not paying more tax? How do I get to pay more income tax? We have capital gains in New Zealand, so it's been a bit of a election issue last time. Labor saying they don't like capital gains, or Labor said they'd bring capital gains tax in. National said we'd keep it out. Believe it or not, there is a ton of legislation already in place to cover capital gains. It's just that we don't tell you that it's there. And National and the successive governments haven't told you that it's actually already in place. And it comes under the general premise that if you buy something with the intention of resale at a profit, okay, it's taxable. That's the general idea. You buy shares, so if Pete gets you buying some shares there, and you say, look, we'll flog these babies off, they're going to be worth a ton of dough next year, so we'll keep those short term, flog those off, buy these ones, sell those ones off, and you're not for the intention of investing for other reasons, like securing your capital, income generation, but you're actually trading on these shares, they're very taxable. There's plenty of legislation in there to say those capital gains are taxable, just like the rental property that you so-called bought, and you bought about 10 of them, and you've been buying and selling rental properties at a great rate of regularity, generally they will be taxable as well. Okay, so you just got to be careful, because IRD have plenty of legislation in place to come along and grab you and shake you and say, that's taxable, and they do it, and we see lots of clients from time to time get tackled on those issues. Tax. Now I've got 3 bullet points down the back there, down the bottom there about tax. Now, has anyone used tax financing? Anyone's accountant got them into tax financing? Anyone know that you can finance your tax? Have you used it? Great. Tax Management New Zealand or someone did it for you? Yeah, fantastic. Okay. 5 odd years ago, some legislation changes were put in place to allow what we call tax intermediaries to be put in place, okay? So you have a very large corporate like Air New Zealand, for example. They might pay $1 million worth of tax, or probably a lot more. Well, in fact, they actually pay very little tax. They don't make real profits because it's all depreciation and stuff. They changed this legislation to allow tax intermediaries to be put in place. So what happens is the large corporates, instead of paying their tax to the IRD, they pay their tax to a tax intermediary who puts the tax money in a big bucket, and the big bucket gets deposited with the IRD. Okay, and the IRD don't know who that tax actually belongs to, but they know they've got their hands on it. So that's great, they're reasonably happy. We've got the money, we just don't know who it belongs to yet. So what happens is that that bucket is able to be accessed by all taxpayers through a tax intermediary, and there's Tax Management New Zealand is the place I use. And what happens is that if you can't pay your tax, you can actually go and buy or defer your tax payment, okay? So I had a client that rang me up the other day and said, look, I can't pay, it's $15,000, I can't pay it. And I said, okay, if you don't pay it, you're going to get interest and you're going to get late payment penalties. So he went to Tax Management New Zealand and we said, look, we want to buy a tax credit for our 3rd provisional tax, but we can't afford to pay that tax until November. They said, fantastic, we'll book that tax payment for you, it costs you $500 in interest, and in November you give us $15,000, you've already paid your $500 up front, and we will deposit your $15,000 tax dated 7th of May into your tax account for the IRD. Okay, and there's no interest or no penalties from the IRD because they think you paid on time. They took the money out of this bucket and says, okay, belongs to that guy there. So you can finance that tax that you owe today if your cash flow is a wee bit tight, or you get to the end of your accounting year, your accountant says, oh, you've got a big terminal tax bill, and you think, I don't know how I'm going to handle this. And he says, yeah, but there's interest and penalties as well, because you missed some of your instalments last year. Remember when you rang me up and said you didn't have the dough, and you missed your instalments, or you were having a much better year than what we thought. And we know with all trusts and all companies, $1 of terminal tax means interest is charged on it regardless, backdated to when you should have paid it. And we didn't know you needed to pay it because we didn't know what you're going to make in the year. So when your accountant says to you, okay, you've got some terminal tax to pay, you could say, hey, can I go and buy a backdated tax credit, backdated to May last year for my first prov tax, and that'll save me some of the interest and maybe some penalties that have accrued over the last 18 months until you told me that I actually owed that tax, okay? So you can do that through Tax Management New Zealand, or if you have a tax audit or a GST audit or whatever, and they say, sorry guys, that return of 3 years ago is a wee bit wrong, you owe us a whole heap of dough, and you say, okay, and they say, that's great, interest and penalties apply to that, and they will, and that runs at 17% a year for the interest and about 7% for the 17% for the penalties per year and 7% for the interest. So you're running at about 25% a year with the IRD if you get it wrong for interest and penalties. You can say, I'll buy a backdated tax credit. Go to them, buy the credit, get it shoved back 18 months. You can buy credits up to about 5 or 6 years old at the moment. Get them shoved back in and save all that hassle, okay? So if you're in that position, make sure you have a wee bell ring in your head. I've got to go and talk to my accountant about buying some tax credits. Because a lot of practitioners are not using it. I don't know why. I think it's just too hard for them, to be honest. And remember, income tax is a self-assessed system. Get it wrong, incur interest and tax, interest and penalties. And as I said, currently the interest is about 7% per annum on a daily basis for getting it wrong, and the penalties are about 17% per annum for getting it wrong. That's why, if it goes on for too long, often you find the interest and penalties is more than the actual tax. And that happens quite often with slow filers. Right, 10 things I know. People in business, and this applies to people in business and people who are investing, just people in general really, they have no strategy and they react to what's going on around them. Okay? That's the classic things wrong. I'm investing, I have no strategy, but I can see that Peter's buying Facebook shares. I told him that I'm no good, but he's buying them, he knows more than me, so I'm going to buy some as well. Okay? Classic case, we see it all the time. No strategy in their business, no understanding where they are, no understanding where they want to go to. But they look at what the people beside them are doing, and that validates their decision to follow them. Okay, and we see it classic all the time. Finance company debentures and that. It was nuts to start with, but you couldn't tell anybody. So this next 3 bullet points down here, our previous speaker talked about evaluating the businesses, etc., and all the maths, etc., of how they actually go and determine what's a good stock pick, etc. One of the things I want to put in there is, in my previous firm, we developed what we call a diamond model principle. All businesses, whether it's you that owns it or it's listed on the share market or whatever, have a life cycle. Okay? If you don't understand where you are in that life cycle, you will have some problems, or they will have some problems. If the business is not revamped, okay, it will die. It doesn't matter whether you're Apple, Coca-Cola, or the local corner dairy. If you don't revamp your business and understand where you're at that life cycle, it will not carry on indefinitely trading the way it is. It will actually eventually disappear. And you think of all the great companies out there that were household names, household products that simply aren't available anymore. Those firms don't exist. They died. They fell to pieces. They closed up. They went broke. Okay? They had great products. There was nothing wrong with their products, and they were making tons of dough, but everything else around them has continued to change, and they stayed the way they were, and they eventually died. And this is part of the problem of trying to assess where a company is in its classic life cycle. Now, if you think of 10 years ago and you went out and bought a record store, CDs and DVDs, etc., you probably won't be around today. Now, when I was in my last firm, we picked up the receivership for Sounds Music Store about 15 record stores around the country. The guy that bought it paid quite a lot of tens of millions of dollars for it in 5 years prior, in the period 5 years prior. Now that business, the person that bought that business did not understand where the life cycle of that business was currently at. And there was no surprise to say that that sector of the industry now is totally dominated by online sales. To buy that business and pay $20 million for it was nuts, because they actually didn't understand where the business was currently at. You think of a big retailer, might be Red, who knows, and where that is in its current market cycle. It hasn't performed well in the share market and is totally unlikely to perform well in the share market in the meantime, unless it does something about its life cycle. It's old, it's tired, it doesn't meet the needs for the customer going forward, the profits are stagnating. Where's the upside? I can think of a million things that would be the downside for those businesses, but where's the upside? So it's the same when you go investing with your shares, etc. You've got to think, it doesn't matter that they're trading well today, it doesn't matter that they're a household name, it doesn't matter that they appear to us to be bright. Where are they likely to be moving forward? Because that's the whole key to the thing. So what we've got is understanding where you are, and we've got this diamond principle, which would be great to come back one day and talk to you about this, but this diamond principle is the 7 stages of where a business starts and where it ends. And unless you understand where you are, you'll have trouble. So the 7 stages, just very quickly, we start off by dreaming the concept. Then we get our dream out of the way and we initiate and implement the business. And then we attack the market, okay? After we finish attacking the market, we start to mature a wee bit, and our business seems to be, trucking along quite fine. Then the market starts changing around us, so we have to overhaul the business, okay? Think of new ways where we're going to head moving forward. After we've overhauled the business, got it back on track, we go into our networking phase where we start to improve the quality of our management and bring in other stakeholders and those types of things to broaden our horizons. And then the last stage, the D, stands for we start to diversify, okay? And if you stop at diversifying, you'll die after that and your business will disappear, okay? This is not theory, this is just simple fact. It's been quite clearly analysed, that's what will happen. But when you're running along these 7 steps here, you can say, I'm here, I'm going to go back to here, I'm going to go to here. And you start bouncing along here, and that's how you get these businesses appear to be totally resilient and adapting to the market. And I think Apple was one of the classics of when it brought out the Apple I and the Apple II. If they were still selling Apple I's and Apple II's, they just simply wouldn't be in business selling MacBooks and laptops. Everyone's selling them, it's no big deal. But they went in and analysed their market and went up the scale and came cruising back down with the iPod, and went up and down and came back with an iPhone and an iPad, and there'll be something else, and they appear to be totally resilient. They are in the meantime, but they've got to carry on doing that, otherwise they will die, because Samsung will knock them off with some other new product, Right, 10 things that I know is that most people get out there and they say, I can do it better than the last guy. I can buy this business, I'm smarter than you, and I can do it better, okay? Generally, not true. Generally doesn't work. Probably one of the biggest fallacies that people have. They self-validate their own abilities and think that the guy before them, the person before them, wasn't that bright, and I can actually do it better. This is not as simple as that. It's definitely not as simple as that. You need to have a strategy. You need to understand where you sit on that diamond model, because just thinking you can do it better than the last guy changes very little. Gives you a wee bit of a shot in the arm for a very short period of time, and then you're just back to the same old problems that they had. We're not making enough money. The turnover's starting to drop away. Things aren't working anymore. What's going on? Okay. 10 things that I know that people try to do is exit their businesses too soon and don't have an exit strategy. If you've got a good, successful business, okay, chances are you won't be able to sell that business and jump into something else that's going to be financially successful for you. If your business is successful, it's probably paying you a premium return on your capital. It should be giving you, we've got lots of clients that, 100, 200% per annum return on their capital. That's what their business is generating. That's pretty common stuff. You've got a couple $1 million to spend. There's lots of businesses, I've got lots of clients that would be generating 400 or 500K a year off that. Now, if they sell that business, and I've had clients that do this, they sell the business with no strategy of what they're going to do next. They sell the business, they get a pot of cash, they go home, they scratch their head, oh, what do I do? Because this is all I've done for all my life. And they're sitting on a pile of cash, and then they get the guilt that this cash that they're sitting on should be doing something. Because it's just not right, I should be sitting on it, I'm missing opportunities. So then what do? They become reckless often with the way they invest their funds, because they're chasing returns that are unrealistic in terms of what they could have, should be achieving. And I had 2 clients that sold their business. I said to them, and I often say to them, hey guys, you'd actually be better to keep this business. It's worth a lot of dough to you. It's got a lot of future earnings potential. Don't sell it. Put a manager in if you're a bit sick of it. And just work a few days a week and keep the fires burning that way. Both of them sold their businesses, and both of them lost all the money, every cent of it, in the next 5 years, because they went and got day jobs and they had sat on a pile of cash and it was burning a hole in their pocket. I've got to buy some shares, I've got to buy some gold, I've got to buy some silver. I'm going to invest in that property and this property syndicate and buy that property. And it was decisions that became a wee bit more reckless in the pursuit to get returns, and they lose it. And that is real common. That is real common, okay? So that's where Pete's there for you to keep you on the straight and narrow. One thing I've learned is that few people get rich from investing. Peter hates me saying this. I haven't told him. I wasn't going to tell him that. I was going to tell you guys this today. Look, I've got a lot of clients with investment portfolios. I've come up through a large national practice who've had a huge financial planning business, okay? If I look at those, and I worked in a share broking practice, if I look at those clients over the last 25 to 30 years, without a doubt, there's probably one hand the number that have actually truly made any money out of their investing, okay? And the part of the reason for that is because the way they go about investing, okay? It's follow the leader stuff. It's through managed funds with layers of fees. It's through financial advisors that are commission driven, okay? It's financial advisors placing the funds overseas with other fund managers, and I don't know what you invested in now, nor are they. And it gets chewed away. It's thinking that modern portfolio investment theory says I've got to chop it up and have some here, there, in every little sector. I went to a presentation with a share broking firm about 3-4 years ago, and they got up and they said to me, I know these guys quite well, and they said to me, look, the reality is the traditional way of investing of the last 25 years, it just simply doesn't work. It's just bollocks. It doesn't work. And I've seen that for lots of clients. I've got clients that have been in financial planning for 25 years. Their investment's worth the same as what it is 25 years ago. And that is no exaggeration. It's because those traditional models don't work, okay? And for that reason, the vast majority of the investing public have gone through those models. Very few self-invest individually in direct investment in stocks, and they haven't achieved anything near what they want. And also the other thing I know is that most wealth is inherited or made out of a successful business, and that's without a doubt. That's without a doubt. You see someone who's sitting on a pile of cash, unless they had a successful business, I guarantee they've inherited it. Okay? Now that's where Peter is to change that for you, so that if you do have some capital, let's make it work for you, because traditionally it doesn't. It simply doesn't, and that's just the absolute truth of the matter. Right. And successful business and investors get superior returns from market positioning, exploiting the opportunities, being in the right sector at the right time and out of the wrong sector at the right time, applying common sense, they all seem to lose their common sense, and don't follow the current theories and what the guy next door to them's doing. Okay? I know I'm just scooting along because I want to wrap this up in 5 seconds. And fear and greed will derail your strategy. Okay? And you can't tell people that finance company bonds are a bad idea because they know more about it than you do. Okay? Thank you, Peter. So hopefully that is a quick wee dance through some things. I know there wasn't much text because I know a lot of you guys weren't going to be in business. I didn't want to bore you too much with tax stuff. But that is some of my insights too from being a practitioner for 20 odd years of what I see looking in through the window of all sorts of people's private lives and all their businesses and working out why you're getting rich and you're not getting rich. Okay?
That's great. Any questions for Brent just while he's here? It's just interesting listening to you talking that last bit. We might have to get you back and fill in a gap I've got in my session this afternoon about why people don't make money.
Why they don't make money.
You're hitting the nail right on the head. A lot of people chase what's out there. You know, everyone's doing it. And whether it's, I mean, it used to be, I remember in Invercargill, it was goats, it was kiwi fruit, it was cherries, cherry farms.
Exactly. We've seen them all, haven't we?
Well, see, Brett and I are a little bit similar because you've got clients and you watch what they do and you see all kinds of people coming to you. And you see some really smart people. Some of our clients are very smart. And some of them just don't get it, you know. And some of them, they come to you to validate what they really want to do.
Yeah.
Now, they don't want to listen to me at all.
No
one
absolutely.
in this room.
No.
This is what goes on. They come to us, and I see husbands and wives playing each other off, and I'm the guy in the middle, you know.
Yeah.
Get that. But people, this is all about this cognitive dissonance that we talk about. You know, you sort of believe what you want to believe, isn't it? And I'll do anything to rationalise and justify my position. And what's funny is some of the things that Brett was coming out at the end there was stuff you've heard from me, and I could see you nodding. Some of you go, yeah.
But you don't listen to it. A lot of them, people just won't listen to it.
No, they don't want to hear it.
Don't want to hear it. Don't want to hear it.
So, but these guys listen.
Yeah.
Listen good. So no
Fantastic.
fighting yet, actually. It's pretty good. So look, thank you, Brent, anyway. That was well done. And I did say to Brent, we might get him back if you like him. So
you don't have to like me. It's fine.
So we'll have a nutter amongst ourselves when he's gone. We'll see what we think. But look, thank you, Brent. I appreciate you getting
No trouble. It's my pleasure, guys. Anything I can do to help, you know.
And we'll probably get him back at some point. He did say to me that those overheads were put together by his 12-year-old daughter. I said, oh, well, I know that because you wanted them done right.
I'd be there all day doing that, so.